Good morning everyone, and welcome to the class in this week. So yeah, let's begin the content in this week. Okay. So yes, for last week we have learned the application is very important concept to remove the first specific risk, but we still have the systematic risk. Okay. So for example, the systematic risk can be the recession period or the interest rate change, and this factor can affect all the market. Okay, in the same time, affect all the market. Actually, currently we have the long war, so the oil price change dramatically, right? So this also belongs to the one kind of the systematic risk. Okay, and we also introduced the KP model, and because the KP model is quite important and plays a key role in the investment. Okay, so the KP model uses the market beta to capture the systematic risk. Okay, so according to the high risk high return, we already discussed before, right? So the expected return only depends on the market beta. So high beta, high return. Okay. So for this week, we voted to ask that whether the systematic risk only market factor, or if we only use the beta to proxy or to capture the systematic risk, is enough or not? Okay, so that's why we will move from the. So that's why we move from CAPM to the APT. Okay, so yes, the CAPM is a useful start point, but we know that the CAPM assumes that the market risk is main sources of the systematic risk, and we also have a very strong assumption under the CAPM model, right? The homogeneous and the investor is rational, a lot of very strong assumption. Okay, so CAPM model may be too simple in the real world. Okay, so in reality, stock return may also affected by another macro factor. For example, like the interest rate, like inflation or GDP growth, even the oil price. Right? So now the new question is that. So can the expected return depends on more than one risk factor? More than one. Okay? So actually it's the background or the motivation of the APT. Okay? So before we begin the APT, so we need to understand the factor first. Okay? So the factor is a common economic force that affects many stocks at the same time. Okay? So the different stocks may respond differently to the same factor. For example, the retail firm may be more sensitive to the business cycle, recession expansion. Okay? And the bank firm may be more affected by the interest rate change. Okay, so in this example, we can note that the different stock can be affected by a different common factor. Okay, so the stock return may be driven by more than one factor. Okay, so here I just repeat again the basic concept. Okay, any question? No. Okay, so to simplify, to introduce that model, so let's begin from again the most simple one, simple factor. Okay, so yes, of course, CAPM is belongs one of the simple factor because we only consider the CAPM beta, market beta. Okay, so the stock return can be divided into two parts. Again, the common factor affects many stocks at the same time, and that part is affected by the common factor, and the other one is very specific event affect only one company. Okay, so you can think about the capital model. We have the market term and the arrow term. Arrow term means the first specific fact. Okay. Any question? So just quickly go through the concept. Okay, so yes, again, y here is the firm return, and which is equal to the expected return plus beta times f. The f here is common factor shock or surprise. Okay, you can just think about this kind of information. Okay, and the e here is the first specific shock. Okay, first specific shock. Okay, so again we separate under the single model here. We separate the step into two parts, actually three parts, right? The expectation from the faster, and the common factor part, and the individual part. Okay. Any question? No. Okay. So interpreting the single factor model. Okay. So yes, a common factor can affect many steps at the same time. So that's why the regression like this one, right? Because here we have I, which means the firm I. Okay, the all this depends in the market. Okay, but yeah, actually it's a very similar concept here. So anyway, this slide I just want to told you that we can use the real data, to construct this kind of regression and try to estimate the beta. Okay? Any question? Yeah, actually the slide is quite similar. So yes, here the idea I want to tell you is yes, maybe in the final hour in this week I will show you how to use the Python to run the data and to get obtain the data. Okay? Okay. Yes, just like Japan. So now we move from the single to the multi-factor model. Okay? Any question? Yes. Okay. The multi-factor model allows stack return to depend on more than one common factor, and this factor represents a different source of the economic risk, and the different stack may have a different sensitivity to each factor. So this factor affects many stacks at the same time. An example like GDP, interest rate, and inflation. So maybe we can look at the formula is more directly, right? So actually similar to the simple factor, quite similar, right? The y is again the stack return, and which is equal to the expectation from the expect in faster, and but here we can include or contain a lot of or more than one factor into the regression. Okay, so the F1 S2 to F, which means this means the common factor surprise, and the beta is the sensitive to this factor. Okay, again, you need to notice that this is I. Okay, so we can run this kind of regression firm by firm. So that's why we said that. Okay, so that's why we said that a different stack can have a different sensitive to each factor. Okay. Yes, so the multi-factor model, any question? So now we have the idea from single factor to common to the multiple factor model. Okay? So now another very important issue. Actually, this question is unclear until now. Okay, so what's what kind of factor is important, or how should factor risk be priced? Okay, so this question can be answered by the arbitrage pricing theory. Arbitrage pricing theory we call the APT. Okay, so the APT is another approach to asset pricing, and it links the expected return to the systematic risk. And yeah, that's why we introduced the factor model first, because APT is based on factor model. Okay, and it relies on the diversification and the no arbitrage. So anyway, here the APT just gives us a broader view than the CAPM, because CAPM is single factor model. Okay, any question? Because CAPM only include the market beta, but under the arbitrage theory, APT here, we can have the several common factor. Okay, so that's why we start from single and move to multiple, then introduce APT. Okay. So, arbitrage pricing theory. So, does anyone can explain what is arbitrage? The meaning or the idea of the arbitrage? What is arbitrage? Does anyone can help me to answer the question? What is arbitrage?
We can earn money without the risk.
Without risk, okay. Yes. Yeah. Sure. Actually, it's the only part of arbitrage, but in the definition we will say that the arbitrage means make money without putting in your own money. So we usually have the long-short portfolio, or we just try to. We also call the self-financing, which means that we can borrow some stock in the market and then sell this market and obtain cash, then buy another one. So overall, we do not take our own money to invest. Okay. So the arbitrage, the first the concept here is that the arbitrage means making money without putting in your own money. Okay, and the basic idea here is one price law. One price law. So one price law means that if we have the two very similar assets, and we find that one is the price goes up and another goes down, then we should buy which one? We should buy the underpriced one and sell overpriced one, right? Because we assume that this kind of the price have the very similar price and the price should be stable. So if we in the long term, and then we just check their price, and we usually use the standard deviation. We just should discount the distance between the long-term average and the current price. And if the current price is greater than long-term average, maybe for example 2 times of the standard deviation, then we can start to buy the stock and the short stock. Okay, actually this kind of tech we call the pair trading is another issue, not in this class, but the pair trading actually is quite interesting. Okay? Okay, so anyway. So the idea behind the arbitrage is that when the similar assets are priced differently. Okay, so the key point here is priced differently. Okay, so investor will buy the cheaper or underpriced asset and sell the overpriced or the expensive one. Okay, so in the end, these trades will push the stock back to the fair value, Okay. Any question? The arbitrage. Okay. So as a result, the arbitrage opportunity should not persist. Okay. So this kind of idea we call no arbitrage. No arbitrage. Okay. Any question? Any questions so far? Any question? Okay. Yeah. Let me. Yes. So if when you read the paper, you need the paper you need to present. Maybe all the paper we will see that the long short strategy, based on one firm characteristic or based on specific variable, and we separate the stock into maybe 10 groups, 5 groups, or 3 tertiary groups based on maybe, for example, size, and then we show the big firm and show long by the small firm. Actually, why we do that? Because we hope we just trade this stock without our own money, okay? And they try to use the arbitrage concept to replicate the mimic portfolio, just like to form a portfolio, okay? Yes, when you present the paper, I will explain it. Okay, so now we have the idea about the arbitrage. So next, let's discuss the diversification matrix for the APT. Okay. So in a diversified portfolio, again similar to the KPN, the firm-specific risk become very small. Okay, so it's less important. So as a result, the first specific shock tend to average out, because when the portfolio becomes larger, if one firm have a good news, there must be other firm have the bad news. So this kind of news will upset each other. Okay, so that's why, actually in this point, it's already different idea if we compare APT and the campaign. Campaign, the assumption of, under campaign we said that why we need the diversification, because the investor will choose the efficient portfolio. Okay, but in APT, they directly use the concept, bad news and good news, and that will upset each other to link the diversification and the efficient portfolio concept. Okay. So what remains is mainly again common factor risk. Therefore, the same conclusion here, right? IBT also focused on the pricing of the risk factor risk. Okay. Do you understand what I mean? Because now, actually, here I'll begin to the different point, right? CAPM, why we need the how to link the diversification portfolio under the CAPM model. Actually, we can have a lot of efficient portfolio, right? And only one portfolio can provide the highest Sharpe ratio, and we link the IF line, the straight line, to tangent the efficient frontier, right? And then we have the CL, CML. Okay? So that's the role of the diversification portfolio under CAPM. But if we discuss the APT, okay, good news, bad news, upset each other. So the remain part is common risk part. Okay, so which story is more simple? Obviously APT, right? Because under a CAPM, we need the homogeneous, we need the efficient frontier, we need the tangent of the IF line to the tangent of the efficient frontier, right? The straight line. A lot of assumption in CAPM, but in APT, in arbitrage pricing theory, only this line. Okay? So the diversification helps separate separate the frame specific risk and the factor risk. Yes, although the conclusion quite similar, but the idea behind each both model is quite different. Okay, any question? So that's why we said that APT is more close to our real life. And yes, another key point is that as the portfolio becomes larger, okay. So another question is another practice question is that how large is enough in your master synthesis? If you're in your master synthesis and you want to construct the portfolio. Okay, so what amount of the frame you should consider in each portfolio? Or how many of the stocks should include in your portfolio? Then we can set a large portfolio. How many firms you should contain include in your portfolio? 30? 50? 100? How large is enough? Usually 30. Why? Because the statistics issue, right? The big sample and the small sample and big sample issue. And another practice point is that sometimes when we separate the portfolio the firm into maybe 100 portfolio, just like the Obama French size B and 10 times 10 portfolio. And in this case, usually each portfolio will not more than 50. Okay, so what I want to tell you is that in the master synthesis level, you just check with your advisor. It's okay. And to confirm that, you can separate the stock based on, for example, size, and to check the number is balanced in each portfolio. It's a more important point. Okay, for example, we have 100 stocks and try to separate the stocks into 10 equal portfolio. So ideally, we hope that each portfolio should have 10 stocks, right? But unfortunately, in practice, it can be the problem. It can be the problem because the firm characteristic will maybe very, very similar. Therefore, we cannot really separate all the stock into maybe 10 groups. So in this case, we should lower the portfolio number from 10 to maybe 5. Or if the 5 is still the problem, maybe we move from 5 to 3. Anyway, in the asset pricing area, we just want to check that we hope we have the equal number. We have the portfolio and the number of the stock in each portfolio are balanced. This is the most important point. Okay? Any question? Okay, so yes, the multiplication. Okay, so idea of APT. Okay, so APT is built on the no arbitrage principle. Yes, the portfolio with the same factor risk should have the similar expected return. So if not, now we have the arbitrager. Okay, arbitrager will trade to exploit the mispricing. If their trade will push price back toward the equilibrium. So the arbitrager will push the price back to the fair price. The equilibrium means the fair price. Okay? And so in a well-diversified portfolio, firm-specific risk is very small, so expected return mainly depends on the common factor risk. So yes, again, therefore, FPT links the expected return to the factor sensitivities. Okay, so yes, the logic of the APT, only two things, arbitrage and the well diversification. That's it. Okay, so yes, for me, I will more prefer APT. Yeah, we understand that the campaign is very important and a story is very beautiful, but the APT is more close to our daily life. Okay, and I really thanks for the APT because after APT, then we have a lot of paper here, right? Because now if we find another factor and which can explain the concessional return very well, then you can have the one paper. Yes. So yes, I really like the APT theory. Yes. Okay, so let's look at the APT directly. For any, we said that for any well-diversified portfolio P here, well-diversified P, right? The P means the portfolio, and which was equal to the sensitive to the common factor, this beta P times the market risk premium. Okay, so that's it. The equation of the APT. Okay. So according to this formula, we can understand that the expected excess return is proportional to the factor beta. Okay, so higher beta, just like the K-pen. The higher beta means the higher expected return. The lower beta means lower expected return. So yeah, APT implies a linear risk return relation. Linear. Okay, why here I want to emphasize linear here because currently we know that we have a lot of the machine learning model. Okay, so actually if you have the regression concept, I highly encourage all the students to learn how to use the machine learning model. Because only different is that in the regression we use linear. But in the maybe like the neural network model or any kind of the machine learning model, we just use nonlinear model instead of the linear. And the other maybe 80 or 90% concept actually very similar. Okay, so now I hope students, if you can understand the idea of regression well, okay. Maybe now, maybe tomorrow, maybe later, you just look at the machine learning model. Okay, it's not difficult. Okay. Okay. Any question so far? Okay. So let's compare the APT and the K-pen. Okay. So both models are related to the expected return. Relate the expected return to the systematic risk. And both models explain the relation between risk and expected return, but the start point are different. Okay? The K-pen uses the market portfolio as a benchmark. But APT do not this constraint. Okay? So that's why when we discuss APT, we do not introduce the market portfolio. Okay, we only focus on the diversified portfolio when the portfolio is large. Okay, And the expected return depends on the market beta. Yes, it's quite similar, the APT model, but here we can consider the different type of the common factor. Okay? And the model is based on the market equivalent, and the APT the model is based on the no arbitrage. Okay? Yeah, the final one, Campaign relies on very strong or with stronger assumption. But the APT relies on the less restricted assumption. Okay, so yes, which one is better? We don't know actually, because if we do not have a campaign, then we don't have the APT. So yes, it's still on debate. Okay. Okay, so of course we can have the multi-factor IPT. So yes, just like this one. Okay, just like this one. Yeah. So each factor represents the different source of the segment risk, and each factor has its own risk premium, and each state can have a different incentive to each factor. Therefore, the expected return is determined by this equation. Okay, again, a different firm and the different common factor. And this beta means the different sensitive to the different factor, and the lambda here is the risk premium. Okay? Any question? No? Okay, so because we have the paper and for the master student, you need to read the paper. So I want to, when we move, actually I already, I finished the APT part. Okay. So let me introduce another very important sense for the master student. But why the Wi-Fi is not stable? This one? Okay. Actually, all the concept for the textbook in the textbook comes from the paper. Do you agree that? Do you think about it? So do you think the question like this? Why when or where the content in the textbook comes from? Where? Actually, all the content or all idea comes from the paper. Okay? So, in general, paper can have the safe ranking. Okay? And because it's the second year, you are the student here are the master student, so you should know the ranking. Okay. So in finance area, we have top four journal. We call the A+ journal. Journal Finance, JV, IFS, and JQA. Okay. So maybe you can guess that. How many scholars or how many professors in Taiwan have A+ paper? You can think about it. Maybe I think they are not over 10. Not over 10 professors have this ranking. of the paper. Okay, so yeah, it's very, very difficult to publish. So if I can have, if in the future I have the paper in this one, maybe I will move to the next university, right? Okay, so next level we call the AT1. AT1. Yes, in the paper in this ranking is still very good paper, but the topic is not good enough. So that's why the only difference, okay? The topic, okay? So for a master student, if your supervisor asks you to read the paper, okay, so I will suggest you the paper you read should not lower than AT1. Lower than AT1. Okay? But it's still based on your concept. If your story is very, very new, maybe the AT1 or A+, you cannot buy that. Okay, it's okay. But if you try to dig in the classical question, please read the paper of greater than AT1. Okay? And here, actually, in the finance area, we have a several. In the finance, we have a several area. The first one is the most common one is the asset pricing. So in the asset pricing, I will suggest the student maybe after 2020, you can read the JBF paper, because after 2020, the editor changed, and the editor really prefer the asset pricing. Okay, and if you dig in the corporate finance, of course you can consider the Journal of JCF, the corporate finance, Journal of Corporate Finance. Okay, and if you want to provide or want to know the empirical test design, JEF is also very popular one. JEF here, the Journal of Empirical Finance. Okay, so in this journal, you will find a lot of interesting empirical design methods. Okay. So next level, yeah. Also, I want to mention the FAJ, the Financial Analyst Journal, Okay, because this journal is most practice one. Okay, and the journal is held by the CFA, the same organization with the CFA. Okay, so if you want to really link the practice and the academic area, maybe you can just read the paper in FAJ paper. And the FAJ paper most important concept is that you need to consider the cost, trading cost. Okay, because when we read a lot of investment paper, actually, we do not consider the cost. Even pharma branch, we do not consider the cost. So if you want to really do some research, it's really close to the practice, you should follow the FAJ paper. Okay. And for next year, we call the AT1 paper. It's still good, but the topic, the method, well, not good enough. So that's why they belong to tier 2. But it's still okay. You can just read the paper in tier 2. Okay, but in your key paper, please greater than AT1. And the main difference is that the AT1 and the A+ and the AT1 paper will release all the details that how they do, where they get the data, and the detailed step, how to visualize the data, how to exclude the outlier. Okay, the paper in the AT1 and the A+ will show all the details show a lot of detail in the paper, but ATL2, yes, you need to more careful in the detail, okay? And then A mine, and the last one is B class, okay? So, any question? For the ranking of the paper, okay? Yes, so yeah, Pharma. So, before we take a break, let me know, do you heard the Pharma French before? So what is Pharma French? And why is very important? What? And another question. We accept that the Pharma is most common one, right? But do we have do they have the competing model? Do they have the rifle? Actually, yes. We also have the Q factor model. Q factor model. So, do you know heard the student here heard the Q factor model before? Q factor. Okay, so of course you do not understand what is the factor war, right? Actually, in the 2015, two very famous papers compete each other and to generate the very famous we call the factor war. And the main story is that yes, we agree APT. We agree we should have the safer common factor. So the key point is that which one or which set of the common factor is most important, most general. Okay, so now therefore we have two sources or two papers. One we call Pharma, another one we call Q factor. And then they just compete or debate until now. Okay, so we will discuss later in next hour. Okay, so let's take a break. Okay.